Welcome back. I'm here today with Ron Cohen. Ron is a partner in the firm of Greenstone, Rogoff and Olson. And Ron, it's good to have you on today's show.
Thank you. Good to be here.
So Ron, how did you end up as a tax partner where you are today? Where did you outlay your foundation and desire really to specialize in income tax?
Well, I had gone the normal CPA route in college and worked with Arthur Andersen for a while back in the 80s, and very quickly determined that where the clients were really interested was how much money can I save or get back. And unlike the audit of financial statements where it's not really a cash thing, tax returns have an immediate impact on people's cash flow, and that was very motivating and enjoyable to do a project, come up with some ideas to save some money, and even if you can't save some money, make sure that things are done correctly so that the client doesn't have to worry about the IRS scrutiny in the future. So we went down that route, and then that led to going into the international world, where I spent a lot of years and still do a lot of international work, which is more complicated. And you always try to, again, I tell clients, you try to stabilize the patient to make sure things are being done right on a compliance level. And then you're always looking for, well, what if we just tweaked it this way? It's all within the law, and we can actually save you some money and be confident that you've done the right thing. So that's a constant daily challenge and very fulfilling as we work through 250 clients of the firm that I work on, and we have near 2,000 clients in total, and you and I consult on many projects from time to time. And so that's how we kind of went down that route. We get, as I'm sure you also, almost every day have clients saying, thank you, thank you, thank you. I never thought of that. That's a great idea. That really changed the outcome, and glad to be working with you. And that, on a daily basis, gets you very motivated.
Ron, what are some of the trends that you've noticed in the past 7 years or so? Have there been big rocks or movements or shifts with the IRS and their enforcement?
Yeah, there's two things going on. It's at the top of the IRS in Washington. The attorneys and the people who run the place have no problem sitting down writing a 50-page regulation and saying, all of you go off and comply, and here's 4 forms to work through the regulation. And at the bottom of the IRS, where they actually interact with the people, the funding's going down and down and down, and the IRS agents seem to have less and less training. And through the conduct of an audit, I'm sure you have the same experience, we end up educating the examiners half the time about, well, you're saying this, but here's the rule. And the IRS has even acknowledged that the CPA community has some kind of duty to educate some of their younger staff. And so you've got these two things that are pushing, especially on the high-end income earners with complex returns like we work on, increased complexity, endless more regulation, endless more rules, endless more forms. And on the lower, they don't even know what they mean, frankly. Half the time. I had an agent last year in an audit say, I don't understand alternative minimum tax. Can you help me out? And I said, well, sure. And we worked through it. But that's a bad law, right? That means it's not understandable, it's not administrable, it's not audible, and yet we always have the duty to do the right thing and get it done as well as we can. So we try to meet that standard. But I see those two things getting worse over time.
I hear this year for the 2015 filing season, that it's going to be even more difficult to reach an IRS representative by phone if you have a simple question. Have you heard anything on that? Or?
Absolutely. I tell clients, if you want me to call the IRS, I'm happy to do it. It's going to be an hour on hold. And I say, you can call yourself and maybe get help, and maybe get information on this, but have a beer, turn on the TV, it's going to be an hour on hold. And the IRS commissioner has come out and said, they're cutting my funding. Sorry, that's the best I can do. So they're triaging. They're saying, where can we best spend the little money we have? And the phone system is not where they see the best bang for the buck, so you sit on hold.
Or it's a message back to the American public, we're not going to respond to you if you have questions.
And indirectly to Congress say, see, you cut my budget, now your constituents will all call the congressman and complain, saying...
There hasn't been any big layoffs or anything, has there?
I think they're having normal attrition. I think morale, I don't, not to get too personal about the IRS, but the people I talk to, their internal morale is not great. So between normal attrition, with people aging out, morale, I will be go as far to say the really good people find a good job with a firm. Not all. I don't want to cast aspersions, but it's a tough place.
So this year, the Affordable Care Act is something that people will begin to see new on the tax forms?
Yeah. The penalties kick in. Last year we had the net investment income tax on the higher end people, 3.8% of capital gains, interest, and dividends. But if you don't have insurance, the penalties, which went all the way to the Supreme Court, is it a penalty, is it a tax? That's all been resolved, and we heard from H&R Block in the news. They're charging people an extra $100 or so to prepare the return, to work through. Does the health insurance? Are you subject to the health insurance penalty? Did you go and get some insurance through the exchange? If you did, do you qualify for the premium credit? I mean, these are 3 or 4 forms on low-income people generally who don't have health insurance. So now you're going to pay more in prep fees and then get penalized as in addition. And I think over these next 6 months, the hue and cry right back to Congress is, we had no idea that this is what you did. The vast majority of people have health insurance, and it's not a burden. They basically check a box saying this doesn't apply to me. But those who don't have insurance, didn't go through the exchange, don't have credits to apply, it's going to get really complicated.
I'm visiting here today with Ron Cohen. He's a tax partner at Greenstone Rogoff Olson Company, and we've been talking about the 2015 tax filing season. Ron, we need to take a quick break, and we'll be right back after these messages with more on taxes.
I love fishing, with my family.
I think it would be easier to use a net.
It was so much fun.
The times when we are together, it makes it all the more worth it.
Having Dad teach them how to cast a fly rod, and
as long as we're doing stuff together, we're having fun.
Some people see a father and a son fishing together, while others see a succession plan. Welcome back. I'm visiting here today with Ron Cohen. He's a tax partner at the CPA firm of Greenstone Rogoff Olson Company. And Ron, we've been talking about the 2015 filing season. People are getting ready. The W-2s are going to be coming shortly, 1099s. What can we expect this year? New and different. Is there anything, any of the hot items that they'll be seeing different on the returns?
Well, we did mention the health insurance for some folks, and the net investment income tax with regard again to the American the ACA, the Obamacare Affordable Care Act. That's not that was in there last year, but we both had clients who paid $10,000, $20,000, $30,000, $50,000 of this 3.8% tax on capital gains, interest, and dividends. I had several discussions with clients and say, hey, look, congratulations, you got to pay for 3 or 4 persons' health insurance. And I think because of this tax that kicked in, so this will be the second year, I think people become more aware of it. These were tax law changes in November of 2012 that applied somewhat to 2013 and continued 2014.
What is the top rate this year?
Federal, it's 39.6%. Income, you get over $465,000 if you're married filing jointly. If you have a capital gain, it's 15% below that $465,000. Again, married filing jointly, and then it's 20% above that. The qualified dividend tax rate also is a split rate, 20% below the $465,000 married filing jointly, and then 20% thereafter. And California, with Prop 30 back in 2012, the top rate is this amazing 13.3% for people who earn over $1 million, because after $1 million, the 1% mental health extra tax rate kicks in, so you go from 12.3 to 13.3. And I was just, we were just talking about, I was at Lake Tahoe this weekend, and I had fun stepping back and forth over the California-Nevada border line going, oh, right now I'm at 13.3%, not myself personally, and oh, step over the line, now I'm at 0% state income tax, and going back and forth. It's an amazing state tax rate. We've both had clients who have basically packed up and moved out of the state because after Prop 30, 13% if you make over $1 million. We have clients certainly in that range. That's a lot to bear for your state tax rate, even more so if the alternative minimum tax for federal makes it so you can't deduct your state taxes. Then you're paying the full 13.3. It's unbearable. Again, in Nevada, 0, and many states are in the 5-3% range, but here we are at 13.3.
With in the high net worth individuals, of course, President Obama has been focused in on this, trying to give greater relief into the middle class, and try to put more burden upon the upper high net worth individuals. What's your take on this?
Well, I without getting too political, he certainly has a point of view of what direction he wants to take the law. Recently, in the State of the Union address, he went after the 529 plans where families can put in a large amount of money into a plan once the baby is born up to the date they go to college. And then they can take any of that money, as long as it's spent for college or books and stuff like that, and pay no tax on all the earnings during that. And he pulled back from that after the urging of his own party that wasn't some abuse by the rich of the tax law. That was a valid promise made that 529 plans would be there and people were able to utilize them. So he's pulled back from that, and that's good.
I've heard some statistic like half of the American public doesn't even pay income tax, to their entitlements or benefits.
The tax rate that at the low end below about $40,000, essentially you pay very little income tax, and most of your tax is Social Security and Medicare.
Yeah.
All the tax on a statistical basis is paid by the top 20 or 30%. And you get to these amazing amounts of tax, the top 1 or 2%.
So, Ron, I need to take a quick break. We're
Sure.
running short against the time here. Visiting with Ron Cohen, tax partner at Greenstone Rudolph Olson Company. We'll be back right after these messages.
When I grow up, I want to work with very successful people.
I want to advise people so that they can pay less tax.
Hang out with my clients on the golf course.
Fishing.
And on their private yachts.
They will all be my friends too.
I want to work with the VCs who will fund the next Fortune 500 company.
When I grow up, I want to be just like my dad.
Money won't buy you happiness in life, but we can help take care of your financial affairs so you can focus on what's really important. Welcome back. I'm here today with Ron Cohen. He's a tax partner at the CPA firm of Greenstone Rudolph Olson & Company, and we've been talking about income taxes. We're getting ready for that this time of the year. People are starting to get their W-2s, the 1099s. They're thinking about, am I going to get a refund or am I going to pay this year? I like to focus a little bit more back on the State of the Union address, where President Obama said that he wanted to have the rich pay more tax and give greater breaks to the middle class. And I'd like to throw a statistic out here, Ron, that for individuals earning over $100,000 a year, okay, that they basically have 60% of the nation's income and pay 95% of the tax in this country. And then if you raise that bar and say, well, people earning over $200,000 a year, they represent just over 5% of the nation's taxpayers and earn 32% of the income, but pay roughly 70% of the federal tax. So if you're looking at the top 5% of America, and this is for the listeners, the top 5% of America are individuals earning over $200,000 a year. So when you're talking about going after and saying we want these people to pay more tax, what's your take on that?
Well, it gets into the theories of what is capitalism, Adam Smith's rule of the invisible hand of capitalism, how the economy grows. And there's an old French proverb that says, I never got a job from a poor person. People need to be allowed to make and keep money to build wealth. Now, certainly there can be excesses. We saw that in 2008. Certain things have to be shut down. But you need to allow people to make and earn money, as we've just both seen. I mean, there are client situations where if you just make it too hard for someone to make a good return, they'll just go to the beach and take vacation. They don't need to set up a business and deal with the state of California and all the regulation and payroll and Obamacare. I mean, they don't need that grief if they're already doing very well. And so you have to allow an incentive for someone to say, well, I'm doing well, I have wealth, but I want more, and I'll earn it fairly. But as Ronald Reagan said back in the 80s, he was an actor, and he said, you know, I went and did parts on some movies, and back in those days, they would take 90% of what I earned on the film as taxes. And he said, why am I getting up at 5 o'clock in the morning and putting on makeup to take 10 cents on a dollar home? And now we're not there at all. The rates came way down because of Ronald Reagan and others. But you have to let that incentive be there for people to do well. Otherwise, they simply won't, and they'll go to other countries, which we've seen. Our corporate tax rate is way out of whack. We're at 35%. Most other countries are in the high 20s or lower. And if that incentive isn't constantly there, people will either go on vacation or just stop and say, I have enough. It's your turn. You go out and do yours. I have mine. And you need this constant, especially as we've both seen it with our clients, for young people. If you don't create opportunities for young people to do well in college, go get a job, have children, start building a house, the whole economic system and the money supply, it all breaks down. It's all based on this growth and constant moving forward. And I think we're getting to the point where a lot of people who have done well, baby boomers, are saying, I've got mine. All I see is risk and tax, and people view me as I have a target on my back because I've done well, and I'm supposed to give part of mine to you because you didn't do well, and I'm going to the beach. And I think that's the problem for the next 20 years, as how do we politically, economically keep the incentives, take care of the poor and the sick in a compassionate way, but still leave these incentives, otherwise the economy stalls. And quite frankly, I mean, all you have to do is look at Japan. Older population, people feeling a little bit desperate about will my retirement be taken care of, squirreling away money, not taking great entrepreneurial risk because the regulations are, well, you think California's bad. Japan is amazing. And people just slow down. And it's a really bad sign that we have to work through. So taxes, the job of government is to make it so that people aren't allowed to break the law, they're not allowed to abuse each other, but otherwise get out of the way for industry and companies to build wealth. And we're at a crossing point politically about what people believe, whether, and I'll just quickly say I was taking a ride with a gentleman from Argentina. He says, in Argentina, beautiful country, 65% of the people work for the government. We know that doesn't work. And you don't get growth, and the young people are suffering. And so that's my long answer to, I don't think it's a good thing. I think it's the wrong direction.
All right. Well, we're running up just a few minutes left here, so let's talk about this this next year. What else do we have to look for? Pretty much the same as 2013 returns, 2014. Any major changes here?
The fast depreciation on equipment, we thought it was going to go down to 25,000. Thankfully, right around Christmas or after Christmas, they came in and brought it back up to 500,000 with certain limitations. That was, we thought that would be terrible if it went down to 25,000. Again, not stimulating people to grow their businesses. But generally, the landscape is roughly the same, except for the ACA stuff for people who don't have insurance. That's a big problem. And it's bad. it's complex. The stockbrokers are taking longer and longer to get the 1099-Bs out. with all your stock trades and all that, because they have things in their back office they have to do to get the numbers right. And so you compact the season where clients get their 1099-Bs from their brokers, on March 25th. They've been waiting all the way since year end, and the returns got to go up out April 15th. So we do a lot of extensions. There's nothing wrong with filing an extension as long as you make sure your client's paid enough tax. But the processing is getting compacted because everybody has more and more compliance to do.
I've been visiting here today with Ron Cohen. He's a tax partner at the firm of Greenstein, Rogoff, and Olson, and he's an expert in this field, teaches classes at a local college on income tax. And Ron, if someone needs to reach you, how do they do that?
At Greenstein, Rogoff, Olson. You can look at our website, 510-797-8661. My extension is 237, or just call the front desk there, and we'll be happy to follow up.
Ron, thanks for being on today's show.
Thank you.
We'll be right back after these messages.